The hook and promise are these 5 rookie ETF mistakes hiding in your account right now. If you're new to investing, ETFs, those exchange-traded funds everyone talks about, might seem like a no-brainer way to get started. But even this seemingly simple tool can trip up beginners in surprising ways. Today on the Capital Breakdown, we're diving into the 5 most common mistakes new investors make with ETFs. By the end of this episode, you'll not only spot these pitfalls but also understand how to navigate them with more confidence and clarity. No jargon, no hype, just straightforward insight to help you build smarter habits from the ground up. Problem or confusion? Here's the thing. ETFs have exploded in popularity because they offer a simple way to own a broad slice of the market. But many new investors jump in without fully grasping what they're actually buying or how ETFs fit into their bigger financial picture. It's a bit like thinking that just owning a basket of apples means you're eating healthy, without checking if the apples are fresh or if you're balancing your diet with other foods. People often think buying an ETF is set it and forget it, but without understanding the details, mistakes happen, like picking ETFs that don't match your goals or trading them like hot stocks. These misunderstandings can lead to wasted money, stress, or missed opportunities. Core concept explained. So what exactly is an ETF? Think of it as a basket, a collection of many individual investments, like stocks or bonds, all bundled together. Instead of buying shares of one company, you buy a tiny piece of that whole basket. This is great for diversification, which means spreading your risk so you're not relying on one single investment to perform well. The exchange-traded part means ETFs trade on stock exchanges, just like individual stocks, so their prices move throughout the day. This combination of diversity and tradability is what makes ETFs so popular. But it also means there's more going on than just buy and hold. Understanding these basics helps you see why some choices work better than others. Core concept explained continued. Imagine you're on a road trip, and ETFs are your vehicle, carrying a variety of passengers, different companies or bonds, each with their own destination. Your job as an investor is to pick the right vehicle for your journey, your financial goals, risk tolerance, and timeline, not just the flashiest car on the lot. Some ETFs focus on big, stable companies. Others chase fast-growing but riskier sectors. Knowing what's inside the basket and how it aligns with your ride plan can save you from unexpected bumps. And just like a car, ETFs come with costs, tiny fees and expenses that quietly add up over time. These basics set the foundation to avoid rookie errors. How it actually works? Behind the scenes, ETFs are managed by fund providers who build and maintain these baskets. When investors buy or sell ETF shares, brokers facilitate those trades on the stock exchange. But unlike mutual funds, ETFs use a unique mechanism involving authorized participants, large financial institutions that create or redeem shares in big blocks. This keeps the ETF's market price close to the value of the underlying assets. Regulators oversee these activities to help ensure transparency and fairness. Meanwhile, the money you invest flows into buying the underlying stocks or bonds, minus management fees that cover the costs of running the fund. These fees might seem small, but over years, they can influence your returns, making it crucial to understand what you're paying for. How it actually works continued. It's also important to realize that ETFs trade like stocks, so their prices can fluctuate during the day based on supply and demand. This means you can experience short-term volatility even if the underlying assets are stable. Plus, some ETFs use leverage or derivatives to amplify returns, which adds complexity and risk. Knowing who's in the driver's seat, the fund manager, the authorized participants, and you as the investor, helps demystify what's really happening when you hit buy or sell. This transparency is key to making informed decisions and avoiding surprises down the road. Simple, concrete examples. Let's look at 2 common scenarios. First, imagine someone who invests a fixed amount monthly into a broad market ETF that tracks large companies. Over time, this person benefits from dollar cost averaging, buying more shares when prices dip and fewer when prices rise, helping smooth out volatility. This steady approach often feels less stressful and aligns with long-term goals like retirement, Now, picture another investor who treats ETFs like individual stocks, chasing the latest trendy sector ETF and trading frequently based on news or gut feelings. This can lead to higher trading costs, emotional ups and downs, and potentially bigger losses. These examples show how the same tool can serve very different strategies and outcomes. Simple, concrete examples continued. Both investors might start with good intentions, but their habits shape their experience. The steady monthly investor builds a habit of patience and consistency, key ingredients for long-term success. The frequent trader may feel the thrill of quick moves, but also the frustration of unpredictable swings and fees eating into gains. This contrast highlights why understanding how ETFs work and how they fit your personality and goals matters so much. It's not about picking the best ETF, but about using ETFs the right way for your journey. Risks, traps, and common mistakes. Now, let's talk about where new investors often get tripped up. One major mistake is chasing niche or leveraged ETFs without fully understanding the risks. These can be volatile and may not be suitable for long-term holding. Another trap is ignoring diversification by concentrating too much in one sector or theme, which can lead to big losses if that area underperforms. Some investors also overlook the impact of fees. Higher-cost ETFs can quietly erode returns over time. And perhaps the biggest challenge is impatience, expecting quick wins and reacting emotionally to short-term market swings. Remember, investing is a marathon, not a sprint, and staying the course often pays off more than trying to time the market. Risks, traps, and common mistakes continued. It's also crucial to consider your time horizon. ETFs designed for long-term growth might be a poor fit if you need access to cash soon. Conversely, parking money in ultra-safe ETFs might not keep pace with inflation if your goals are decades away. Balancing risk and reward based on your personal timeline and comfort level is a foundational principle. Above all, avoid the trap of set it and forget it. Without periodic reviews to ensure your ETFs still match your evolving situation, this ongoing learning and adjustment mindset is what separates thoughtful investors from those who get caught off guard. How to think about this tool. When you zoom out, ETFs are just one piece of a bigger financial puzzle. Before investing, it's wise to have a solid budget, an emergency fund that covers several months of expenses, and clear financial goals. ETFs can be great building blocks for retirement accounts or long-term savings, but they aren't magic bullets. Think of them as reliable tools in your toolbox, versatile, accessible, and cost-efficient when used correctly. Align your ETF choices with your broader plan, including paying down high-interest debt, saving for near-term needs, and protecting yourself with insurance. This big-picture perspective helps keep your investing steady and purposeful. How to think about this tool continued. It's also helpful to remember that no investment is without risk. Even broad market ETFs can lose value during downturns, and past performance doesn't guarantee future results. Staying educated, patient, and diversified helps manage these uncertainties. And don't forget, your financial situation, goals, and risk tolerance are unique. That's why doing your own research and consulting qualified professionals when needed is so important. The Capital Breakdown is here to empower you with knowledge, but the final decisions always rest with you. Building confidence takes time, but every smart step forward counts. Recap and educational disclaimer. All right, to wrap up today's episode on the Capital Breakdown, we uncovered 5 common ETF mistakes, like misunderstanding what ETFs actually are, chasing risky or concentrated funds, overlooking fees, trading too frequently, and ignoring your personal timeline. Remember, ETFs can be powerful tools when used thoughtfully, but they require patience, research, and a clear plan. This video is purely educational and not financial advice. Always do your own homework and consider talking to a qualified professional before making investment choices. Thanks for tuning in, and here's to your savvy, steady journey toward financial confidence. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.